At the end of the day, if you think about the next 10 years, I don't think it's lost on the administration that whatever we're fighting for, like onshoring, it's a very different argument in 10 years, because in 10 years, robots are going to be very capable, and AI is going to make the robots a lot more fire and forget. So if you want to make iPhones in America with like robots that have the dexterity of a worker in China, that's going to actually be economically possible. So maybe they're coming to some agreement on robot technology, because China is way ahead of the U.S. on that. So I'm just guessing. I don't know.
Tom Lee claims that the recent 10% slide in the stock market over a few weeks is rather than the beginning of a financial catastrophe, but rather a waterfall decline. Rapid sell-offs like this one frequently arouse concerns about a serious crisis, like the one that occurred in 2020. However, Lee thinks that this time it's not a symptom of actual economic crisis, but rather an overreaction brought on by worry. Markets are currently pricing in a 40% chance of a recession, according to him, although that may reflect investor mood more so than real fundamentals. If you're intrigued by bold predictions and deep financial insights, make sure to like this video, subscribe to the channel, and turn on notifications for more engaging content. Thank you for your support and enjoy the video.
Market went up. There wasn't any disastrous things that happened on the weekend. The market rose a little bit here today. Just tell us a little bit about where you think we are right now.
Thank you, Bob, for the intro, by the way. Appreciate it.
I meant it.
Yeah. I think the market's trying to catch its breath right now, because we had 2 years of 20% gains, so we know a lot of good news was priced in. And now with a new administration and really a bold plan to use tariffs, to sort of fix the economy, and this part of a bigger plan to fix taxes, and DOGE to cut government spending, there is a natural, markets want to sit on their hands and wait and see what's happening. And so I think that's why we've had the kind of decline we did, but 10% in 20 days, that's a high-speed decline. That's what we would call a waterfall stock market decline, and there's something that you should be mindful of. A waterfall decline can be the start of a crisis, like that happened in 2020, or it could be just the markets panicking. And with a 10% decline pricing and a 40% chance of a recession, I think we're probably more in the category the market panicked, because there's a lot of uncertainty right now. But I think we're going to get through this, because we know there is a Fed put. As far as Washington goes, I do think we are living in a period of uncertainty for now. I think investors are going to realize that a lot of great stocks have come in, hugely. And the S&P's down 10, but a lot of good stocks are down 50%. And I think that's why, there's a very good chance we made our low for the first half already, or maybe for the year. What has caught everybody off guard, including us, is that the tariff headlines, we understand, okay, Trump wants maximum leverage, so he's going to speak with as much force as possible, and that should rattle markets and leaders and try to force a negotiation. But I think what is surprising is how quickly business confidence has collapsed and consumer sentiment has collapsed, and actually it's actually dragged down economic activity. So I think we are now risking the economy hitting stall speed if we have tough talks. And look, it's pretty evident. This weekend it was a quiet weekend, because I think they realized, this message of we're okay if the economy rolls, that's a huge tactical mistake, because as soon as, do you remember what Fed Chair Powell said in August when he says there's pain ahead? That triggered a pretty big growth scare. The pre-announcements are a very bad sign, because that didn't happen with other drawdowns, right? Like last August we had a 10%. It's not like companies were pre-announcing things got softer. I think tariffs are a financial restructuring of the U.S. economy. So there's clearly a lot of uncertainty, but also everyone here needs to keep in mind a president can't restructure the economy unless Congress changes the law. So it's obvious that if someone said, okay, who should be the bullseye of this tariff war, it really should be China, because we know China subsidizes so many things. And look at even processing of rare earth minerals, right? China has created a monopoly through their direct subsidies. And yet, in all this public rhetoric, that's the one country that's hardly named. And it shouldn't be oh, it's obvious because Trump knows we all don't. We know you need a new deal. I would probably interpret to say they must be making progress, so he's decided not to sort of bash them to bring them to the table. And that would probably explain why NVIDIA has been outperforming as well. Yeah, I think if there was a global trade war and we risked a recession, NVIDIA would still be derating. The PE should be coming down because all of a sudden everyone wouldn't even know what the E looks like, you know? But so the fact that that's stabilized, I think, is very telling. And, you know, at the end of the day, if you think about the next 10 years, I don't think it's lost on the administration that whatever we're fighting for, like onshoring, it's a very different argument in 10 years because in 10 years, robots are going to be very capable and AI is going to make the robots a lot more fire and forget. So if you want to make iPhones in America with like robots that have the dexterity of a worker in China, that's going to actually be economically possible. So maybe they're coming to some agreement on like, you know, robot technology because China is way ahead of the US on that. So I'm just guessing.
Tom Lee advises investors to maintain their long-term perspective. He disagrees with the notion that simply because U.S. stock prices are high, investors should sell them. Lee claims that the United States continues to provide a special combination of advantages, including top-tier businesses, a robust innovation culture, CEOs that put shareholders' interests first, and a regulatory framework that, despite its flaws, is superior to most others worldwide. Lee suggests looking at nations like India or portions of Africa that have robust workforce trends and expanding populations if you're considering expanding your global reach. To remain up to date on the most recent developments in Bitcoin, cryptocurrencies, and the digital economy, please take a moment to like this video, subscribe to the channel, and enable post notifications.
How evident would this be this Wednesday when Jerome Powell speaks?
Yeah, there's a couple things to keep in mind. The Fed put has always existed because, with the exception of Volcker, but Powell's talked about this, there's a recognition that the stock market is the sentiment indicator of the economy. Like if you tank the stock market, there's no GDP expansion. Consumer confidence doesn't go up if the stock market crashes. But that message got muddled the last couple of years because inflation made it hard for the Fed to actually try to support the stock market. And I'm not trying to rile the waters, but I think there is a political dimension because the White House is very divisive. Half the country didn't vote for the current president, and I think the Federal Reserve, even though they're independent, many of the people that work at the Fed, I think it's 94% of donations were to Biden's reelection. So it's clearly an institution that favored the party that lost. And I think that's why it's been hard for Powell to be like, I can ignore tariff headlines. I think because, he's got an entire organization that doesn't agree with him. But I think the put exists because 2 weeks ago, Fed Chair Powell was speaking, and he talked about in 2019, tariffs were inflationary, but he still cut rates 3 times. 33 years ago, the institutional investor said long-term meant 12 months. And so they didn't care about anything that you had to say unless it was going to change the 12-month outlook. And then probably in the 2010s, that changed to 1 quarter. Okay, so that was 15 years ago. And now in the institutional world, because of all these ways people measure factor and your risk and your value at risk, it's like 30 days. So people don't care if something's 31 days from now. If the stock's going down next 29 days, they're gonna sell. And people have instant liquidity. So it's not just like someone in Robinhood that can go to zero. Any major hedge fund can essentially turn their beta to zero. They can literally go to flat on the market with a push of a button. So I think the stock market does face rage selling now. And MIT had a very big headline study that came out in 2020 that said something like 57% of adult males rage sell. Meaning like, it's actually, so if you look at the stock market.
By rage selling, you mean they just irrationally come in and decide to sell on a hunch? Like
yeah,
they're done, or is there rage buying?
Yeah, so they're literally like, imagine like a race car that's going 100 and 0. Like there's no speed in the middle. Whereas a female don't rage sell. So it's actually a gender thing, rage selling. Tariffs are so complex. Like Ken went through and tried to calculate tariff rates for U.S. bilaterally with different countries, and you can weight it by trade or you can do equal weight. And by the way, when you do that, none of the numbers match up to what Bank of America's tariff numbers are. Like, nobody actually knows the real tariffs. I mean, it's really hard to calculate, which also means, like, how can you, by April 2nd, negotiate 100,000 line items with, like, bilateral with all these countries? So I think that there has to be concepts that are agreed upon. And, like, for instance, with China, you know, very likely a lot of it has to do with AI and intellectual property, you know, not necessarily steel and aluminum. I wouldn't recommend someone saying, well, the US is done, and so the next 10 years, because it got expensive, I'll just buy Europe. Unless you're really confident Europe has the same number of good companies with the innovation and regulatory freedom.
Oh boy, that's a big lineup.
And a buyback culture and a CEO obsessed with the stock price and employees who get a lot of stock so they care about what the stock does, and in a regulatory environment that's getting better, then you should buy that country. But, like, you know, just in the U.S., if...
But you're answering your question. You seem to be cynical about whether that's actually available.
I mean, I'd make it more of a demographic play. Like, I'd bet on Africa and India because they have got a lot of good things happen when you have surplus workforce.
In moments of panic, Tom Lee is advising investors to stand back and consider the wider picture. According to him, the so-called Fed put still holds true, which means the Fed won't allow markets to fully fall because a collapsing stock market undermines consumer confidence and hinders economic expansion. Lee claims that despite the Fed's recent restraint due to high inflation, it is evident that they recognize the intimate relationship between the stock market and the economy. He also discusses the political dynamics within the Fed, pointing out that despite its independence, the majority of its employees have a tendency to tilt one way. That may have an impact on how choices are made, or at the very least, how they are expressed. However, Lee points out that Jerome Powell lowered interest rates in 2019 despite worries about inflation, demonstrating the Fed's continued capacity and readiness to support market stability when necessary. Lee also highlights the shift in investor behavior. Institutions used to base their decisions on a 12-month forecast. The focus has now been reduced to a month or fewer due to real-time data, immediate trading tools, and rapidly shifting markets. This contributes to the widespread panic selling and rapid stock dumps that occur based on short-term anxiety rather than long-term fundamentals. Regarding the global economy, Lee cautions against investing all of your money in foreign markets, such as Europe, simply because U.S. stocks appear to be pricey. He contends that unless other nations can equal the U.S. in terms of innovation, business culture, and shareholder attention, it is best to continue with what is effective. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.